Good morning, everyone, and welcome to our conference on corporate climate risk, assessment, disclosure, and action. My name is Jayni Hein, and I am the Natural Resources Director at NYU School of Law's Institute for Policy Integrity. We are pleased to co-host this event with the Volatility and Risk Institute at NYU Stern School of Business. I'm so encouraged to see that so many of you have tuned into this event from near and far. I want to thank our co-hosts and all of the staff members who have been so helpful in organizing this event. I also want to thank my former NYU colleague, Madison Condon, who's now a law professor at Boston University, who started planning this event with us all the way back in January and has been critical to its fruition. As our distinguished panelists will discuss today, a number of recent events have underscored the importance of corporate climate risk, assessment, disclosure, and action. The physical threats that climate change poses are here in increasingly disruptive and costly ways, from the devastating wildfires burning on the West Coast to the ever more frequent and severe hurricanes and flooding events across the United States. These systemic climate risks are already affecting investment portfolios. From 2015 to 2019, direct economic losses from extreme weather events in the United States totaled more than $500 billion. The mounting economic risks of climate change have finally started to receive mainstream attention from investors, media, and the public. And despite a clear void in federal leadership over the past 4 years with respect to climate risk disclosure and action, and in fact, some unfortunate moves away from better disclosure, the private sector and government advisory committees have begun to take meaningful steps to measure and address these serious economic consequences. As one high-profile example, in early September, a federal advisory committee to the Commodity Futures Trading Commission released a groundbreaking report, Managing Climate Risk in the U.S. Financial System. The key takeaway of the report is stark. Climate change poses serious risks that, if ignored, will undermine the financial system's ability to support the American economy. Investors and companies are also slowly responding to the transition risks presented by climate change, like the billions of dollars of assets that remain invested in fossil fuels and related infrastructure that will increasingly lose value in a warming world that must transition to clean energy. Last week, Morgan Stanley pledged to reach net zero financed emissions by 2050 by adjusting billions of dollars in its loans and investments away from fossil fuels. While received as an important step in the right direction, critics took issue with the lengthy 2050 timeline, and implementation questions remain. Now, our distinguished panelists will discuss these climate risks and identify opportunities to better measure, report, and act on them. We'll also discuss how government agencies could be doing much more to increase climate risk disclosure and encourage environmental, social, and governance, or ESG, tools and strategies, rather than enact barriers to using them. The issues we're going to discuss today are very important to the Institute for Policy Integrity's work. For those of you who aren't closely familiar with us, Policy Integrity is a nonpartisan think tank at NYU School of Law dedicated to improving the quality of government decision-making. Many of our projects focus on clarifying and disclosing the massive social costs of air and climate pollution, and working to make sure that they're properly considered in policymaking, as well as by the private sector. For instance, we filed comments on the Securities and Exchange Commission's recent modernization of Regulation SK, which unfortunately will have the effect of reducing climate risk disclosures rather than increase them. We also commented on the Department of Labor's proposed new rule that would make it harder for ERISA-regulated retirement plans to invest in ESG funds, contrary to the growing weight of evidence that ESG funds often financially outperform their more traditional peers. I want to now turn the stage over to my former colleague, Madison Condon, who has been a key partner in organizing this event. She is now a law professor at Boston University, where her research focuses on the intersection of climate change and corporate law.
Thank you so much, Jayni. I am really excited about today's event, which was unfortunately postponed. It was supposed to happen back in March. But in some ways that was a blessing because it's been a really interesting time between now and March in the world of securities regulation and climate risk in terms of the amount of attention it's finally receiving from the broader regulatory world and private actors. So we have a really interesting lineup today, and I'm very excited to learn from our experts who have taken the time to join us. Starting shortly will be our first panel, which is on assessing the financial risks of climate change. And we'll have speakers from data and accounting firms and a regulatory advocate who will each give us their perspective on physical risk, transition risk, and liability risk as it relates to climate change. That will be followed by a lunchtime talk between 3 renowned economists on the challenges of incorporating climate risk assessment into market prices. Next, we'll hear from private sector representatives. A law firm partner with a developed ESG practice will compare notes with a US energy company and a multinational that has already been complying with some climate risk disclosures as its headquarters are in France. And finally, we'll have former SEC Commissioner Rob Jackson, who will speak with Policy Integrity's Director Ricky Revesz about how the US regulatory system can respond to climate risk mispricing in the markets. So I have some logistical points to cover. If you are an attorney that is seeking CLE credit from today's program, we will be showing codes in the first, third, and final sessions that you will need to write down to remember to submit to your CLE credit, for your CLE credit. My colleague Christine Pries will be sending you an email at the end of today's event, and it will include a link for you to verify your attendance and to submit those codes into the attendance form. Today's session is being recorded, and it will be posted to Policy Integrity's website and on Policy Integrity's YouTube channel. And one final point before we kick off the first panel of the day, please use the Q&A feature that is part of Zoom. You can send all your questions to the panelists through the Q&A feature by typing it in, and each of the session's moderators will choose questions from the Q&A stream to ask our panelists to answer for everyone's benefit. And each of our panelists has left a great deal of time for question and answers and for discussion, so I really encourage you to take advantage of that. So let's see. Without further ado, thank you, Jayni, for helping organize this conference and for all your work in the recent weeks, and especially all the help of Policy Integrity staff and for our great partners at the Volatility and Risk Institute at NYU Stern. And let's kick off, let's begin to transition to our first panel, which is on assessing the financial risks of climate change. Thank you so much. For the first panel of the day, assessing the financial risks of climate change, we have 3 wonderful speakers, Veena Ramani, Lindsay Ross, and Brigham McNaughton, who I will briefly introduce before they each I'll introduce them each before their own presentations, and they'll each talk for about 10 to 12 minutes. We'll do the 3 presentations back to back, and then we'll have a panel discussion between all 3, and we will open it up to the audience for questions. So let me introduce our first speaker, who is Veena Ramani. She is the Senior Program Director of Capital Market Systems at the nonprofit Ceres, which is based here where I am in Boston. She leads Ceres works on critical market levers that will help scale the transition to sustainable capital markets. This includes engaging with financial regulators and members of boards and corporate leadership through the Ceres Accelerator for Sustainable Capital Markets. She is the author. I really encourage you to check out this report. It just came out this summer. It's a 2020 Ceres report, Addressing Climate as a Systemic Risk, a Call to Action for US Financial Regulators. And the report makes the case that climate change poses a systemic risk as opposed to like an idiosyncratic firm-specific risk to the financial system. and US financial markets. And the report outlines over 50 action steps that financial market regulators can take to address this challenge. So thank you so much, Veena, and take it away.
Great, thanks very much, Madison. I believe I'm going to sort of show my technological prowess right now by trying to share my screen. Let's see. All right. There you go. Okay, so can everyone hear me? Can everyone see the screen? Just nod. Okay, all right, let's assume that everyone can do this again. Thanks very much, Madison, for that kind introduction. Thank you to the Center for Policy Integrity for inviting me to participate in what I think is going to be a fascinating day and certainly a fascinating panel. So Madison gave you a quick sense of what I do at Ceres. You know, I am the Senior Program Director of the Capital Market Systems team at Ceres. I think that means I'm Ceres' head governance geek. I spend my days really thinking through how environmental and social issues like climate change, human rights, water scarcity, what they mean in terms of decisions that are being made by critical capital market actors, whether it's companies, investors, or financial regulators, which is what I'm going to talk about. And as Madison said, this summer, I have been spending close to a year now really marinating into the exceedingly complex world of the US financial regulatory ecosystem. A, trying to understand what their roles are, and B, trying to understand to what extent does climate change fit in. And the results of our research is the report that Madison referenced in her introduction. It's a report called Addressing Climate as a Systemic Risk, a call to action for global financial regulators. And what I'm going to do over the next bit is run you through the report recommendations. So this report makes two core arguments. One, it makes the case that the impacts associated with climate change are so profound that it's not just financial to individual companies, it's not even material to companies, or not just material to companies and to industries writ large. The impacts are so profound that they pose risks to the very stability of global financial markets and national financial markets. And given the stability risk, the second argument that we make is that US financial regulators who have a role and a responsibility as a part of their existing job descriptions to maintain that stability should take action right now to address climate change. The report lays out what those actions could be. Our report is focused on both federal and state financial regulators. I'll talk about who they are in just a minute. And it's definitely based on a fairly detailed legal analysis, literature review, and I will say dozens and dozens of conversations that we had with stakeholders in the space, including folks from the regulatory community, advocates, investors, academics, lawyers, and other stakeholders. So over the next few slides, I'm going to talk in a little bit of detail about the report, starting with the case that we make that climate, in fact, poses stability risks to US financial markets. So here you start to sort of get a sense of our arguments. It's not something that I think I need to really elaborate to this group. These physical impacts are happening all around us. These physical impacts are also happening now, right? All of us, I know this is quite a wide audience on the line here today, including, I'm imagining, people from the West Coast who are still dealing with the impacts of wildfires, which have become more frequent, more extreme, certainly exacerbated by climate change. We've had the worst hurricane season on record. The scariest news I've heard from a physical impacts of climate change perspective is that we've seen two glaciers, major glaciers break away in the Antarctic, the impacts of which will likely be sort of significant and accelerated sea level rise, which affects certainly every coastal community in the US. We've seen hurricanes, we've seen typhoons, extreme weather events are happening around us. These extreme weather events are clearly significantly financially impactful in of themselves, but they also lead to cascading impacts, particularly on issues like health and productivity, community impacts, population upheaval, biodiversity losses that affects many core industries as well, each of which have economic and financial consequences of their own. Many of these impacts are starting to manifest themselves in the largest states in the country, including California and Florida. We make the case that an unplanned, even though it is inevitable, transition to a low carbon economy, that it will impact and cripple major industries. So in other words, the transition risks of climate change, where they are not planned, are going to be financially devastating, we believe, and there are studies that reiterate this. Our report in particular pulls out, of course, policy risks, but also liability risks, the growing litigation we're starting to see around climate change, as well as market risks, like the technology evolution we're already starting to see, as well as stranded assets. But clearly there's always an investment upside as well, which many investors and financial institutions are starting to take advantage of. You know, transition impacts affect key industries, but they also clearly have an impact on the financial institutions who are invested in those industries, particularly banks and insurance companies, whom we believe, research shows is on the front lines of these risks. And given the right incentives, also stand poised to take advantage of the opportunities associated with the transition to a low carbon economy. Insurance companies, of course, face growing losses from payouts as a result of extreme weather events. And as one of the largest institutional investors in the world, they also face exposure through their investments. And of course, banks face carbon risks across their portfolio. And in each of these sections, this report supplements our arguments with study after study that underscores the financial impacts of the factor that we point to and extrapolate it back to the economy as a whole. But what is interesting about climate change is not just each of these impacts I've talked about right now, it's the fact that each of these impacts implicate each other, right? None of these impacts happen in isolation. They interact with one another, and they have cumulative impacts. And it's what we understand, or I suppose more accurately, what we don't understand about how these impacts interplay with one another, which poses the real risk to financial market stability. And we call on financial regulators to take action right now. In the rest of the report, we lay out a series of steps that financial market regulators could take to address climate change as a part of their existing mandate. As Madison mentioned, the report includes over 50 specific action steps we are looking for financial regulators to take, but they fall within 4 core buckets. The first bucket of recommendation relates to affirmation, which is something that we believe can happen now. To be honest, could have happened yesterday. We call on US financial regulators to affirm that climate change is a systemic risk, and we call on them to start to assess the impacts on financial market stability vis-a-vis their own specific jurisdictions. Next, we call on them to integrate climate change into their prudential supervision of the industries that they focus on. So for banking regulators, it's financial institutions. For securities regulators, it's on markets writ large. We've just heard about some of the actions that the SEC is starting to take on climate, that certainly affect the ability of investors to engage on climate change using all the tools at their disposal, which is unfortunate. For insurance regulators, it means the insurance market. So clearly there are, for mortgage regulators, it's the mortgage market. There are clearly many ways that this starts to percolate across various industry sectors. The next bucket of recommendations relates to climate change disclosure. We call on financial market regulators to mandate climate change disclosure in any which way they can. Clearly, the SEC has the primacy here, and our report includes a specific recommendation calling on the SEC to mandate TCFD-based climate change disclosures, but we believe that there are sort of creative ways in which various regulators could exercise their mandate of supervision to encourage more disclosure from agencies that they supervise. So for instance, we're already starting to see state insurance regulators, some state insurance regulators starting to require climate change disclosures from insurance companies that operate within their jurisdictions. Climate change disclosure, I believe, is so fundamental to so much of what we're asking for. The purpose of the exercise here is to get markets to appropriately price in climate change risks and take smart decisions at the company level, at the industry level, at the portfolio level, and at the regulator level. You can't make good decisions without good information. And while the volume of climate change disclosure has certainly increased, That disclosure is still not happening at scale. We're still not seeing disclosure of information that investors and regulators need to really act and make smart decisions. So we need that mandated to get that information out there at scale. And we finally call on the US regulatory community to coordinate both with each other as well as with the global regulator community to develop a shared playbook for action on climate change going forward. I will say that our report notes that all of the actions that we call for falls within the existing mandate of the agencies in question. Legislation may be helpful to speed the pace of what is taken. It could be helpful to prod action where there may be some ambiguities, but we believe that everything we call for builds on what financial regulators are supposed to do right now, and in many cases builds on action they've taken on similar issues in the past. We've seen similar action taken by financial regulators globally, so there's clearly a template for action. We also believe that as the regulators of the largest economy in the world, US regulators have a particularly strong affirmative duty to act, and that the US economy risks being left behind if we fail to act and take the action that we are seeing happen in other jurisdictions. And while this blueprint focuses on half a dozen key institutions, which I'll go through in just a minute, we believe that there is a role that all financial regulators could play at the federal, at the state level, and in fact, beyond the financial regulatory community itself in terms of taking action on climate change. This slide lays out, gives you a quick sense of the regulators that our report focuses on, including, as I've mentioned before, banking regulators, the Fed, the OCC, and the FDIC, securities regulators, the SEC and the CFTC, insurance regulators, both at the federal and the state level, the Federal Housing Finance Agency, given its oversight over mortgage-backed assets, and the Financial Stability Oversight Council, whom we believe has a critical role to play in both prodding the regulatory community to action as well as allowing for the coordination that needs to happen. So let me stop there and pass it back to you, Madison.
Thank you so much, Veena. I'm so glad that we had you to kick off the event and to speak first for the day, because I think you've really set the tone and done an amazing overview of like what exactly we're trying to get at today. And I look forward to hearing some of the answers to the questions that the panelists, that our audience, I'm sure, will have. So next we will go to Lindsay Ross. And Lindsay has a very interesting job. She works for, she's the director of global client services at 427, which is, I would say, the leading or definitely one of the first physical data risk providers. And well, maybe she'll, I don't know, Lindsay, would you call yourself a consultant?
We started as an advisory firm, but have moved towards data products. So okay. I'll speak a bit about that today.
So her job is to analyze, to actually try to figure out the economic impacts of climate change on corporations and financial markets with a focus on physical risk. So where the hurricane's going to hit, what types of assets are going to be underwater. She helps clients, including multilateral development banks, real estate investment trusts, asset managers, and asset owners, to understand the economic and financial impacts of physical climate change. Previously, she worked at the US International Trade Commission, assisting with macroeconomic research on the impacts of international trade in the US economy. So Lindsay, I'm really happy that you're joining us, and take it away.
Great, thank you. Yes, thank you, Madison, for having me here today, and thanks to NYU as well for hosting this event. Today, I'm going to talk about physical climate risks, like Madison just mentioned, and their impacts to financial markets. I'll discuss how physical climate risks affect investments in corporate equity and fixed income. I'm the director on global client services for 427, and we're an affiliate of Moody's, which is a leading provider of data, market intelligence, and analysis, and we bring to the table the physical climate and environmental risk component of that. We analyze physical climate hazards that pose an immediate threat to investment and loan portfolios, as some of the speakers today have already mentioned, including floods, heat stress, hurricanes, sea level rise, water stress, and wildfires. Today, I'll be talking to you about how 427 uses global climate models and what type of decision useful financial information can be derived from using this data. In particular, given today's topic on corporate climate risk assessment and disclosure, I'll speak about how to meet forthcoming regulations already discussed by some of the other panelists and to be discussed, I'm sure, at length later today. As you can see in the graph on the left, we've already observed global warming reaching approximately 1 degree Celsius. Shown in the graphic on the right, the IPCC, the Intergovernmental Panel on Climate Change, issued a special report on climate change and land, which shows we've already reached more than 1.5 degrees Celsius of warming on land. What all of this means is we're moving away from our historical climate into a future with more frequent and severe physical hazards. And these events are both deadly and costly. As Jayni mentioned at the beginning of the day today, large disasters in the last 5 years have cost the US $525 billion. It should be no surprise to many of you, given recent hurricane events in the Southeast and wildfires in the Western US, that we've moved away from the historical climate and are in a new climate that's already characterized by more frequent and severe acute weather events. Besides acute events like hurricanes and floods and wildfires, chronic events like rising temperatures and rising sea levels are already also occurring and are expected to worsen into the future. Hurricane Laura in September caused storm surge in Louisiana and Texas that reached nearly 20 feet and had winds that caused an estimated $8 to $12 billion in damage. Early estimates of losses from property damage and business interruption from the wildfires in the Western US are estimated to be between $4 and $8 billion. Quickly, I'll run through some examples of how physical risks affect companies and more broadly, how they affect financial institutions, which demonstrates why regulators are calling for increased disclosure, especially internationally. There are direct impacts to company facilities, which can disrupt their operations. A recent example is flooding in Wuhan in China, which disrupted operations of a manufacturer of PPE, which obviously has heightened impacts during a global ongoing pandemic. Less obvious examples include the impacts of heat stress and wildfire smoke. Research on the impacts of extreme heat, published late last year, found, quote, significant and sustained negative returns and an increase in equity price volatility in response to extreme heat events. Wildfires in Australia last year caused productivity losses estimated to be between $12 million and $50 million per day from transportation infrastructure disruptions and illness from wildfire smoke. Beyond impacts to facilities and operations, companies can also experience climate impacts to their supply chains, where they source their inputs, as well as their markets, where they sell their goods. For example, last year, Subaru had to halt operations during Typhoon Hagibis due to impacts to their suppliers. Regulators care about this a lot because the exposure of these companies can affect bank balance sheets and other financial market participants like asset managers and asset owners. Today, I'm focusing on corporate equity and fixed income, but at 427, we can analyze any facility on the globe for its exposure to climate hazards, meaning we can also deduce the climate exposure of portfolios comprised of real estate, infrastructure, and other private equity. A large number of central banks and supervisors in the Network for Greening the Financial System understand that the exposure of all these various types of asset classes to climate hazards represents a systemic risk to the financial system. Regulators like the Bank of England and Banque de France have piloted TCFD-like disclosure within their own portfolios, leveraging data from 427 to disclose the physical climate risk within those portfolios. 427's expertise is in translating data available in physical climate models into decision useful and actionable metrics so that investors can better understand the exposure of their portfolio holdings to climate risk. Beyond data from physical climate models, we also take data from a range of other sources, including company facility information and data on global trade flows, to provide a holistic view of a company's exposure to climate risk in their operations, supply chains, and markets. I want to highlight the importance of conducting analysis of physical climate risk at the most spatially precise scale possible. All of our analysis across the range of asset classes that we cover starts at the facility level with an address or latitude-longitude coordinates. The map on this slide illustrates our database of all our corporate facilities and their exposure to flooding. From there, we take information on the facility's exposure to climate hazards and aggregate it to the company level. Our data is used by a range of clients, including investors, asset managers, commercial banks, companies, finance agencies, and government agencies. And clients use the data to perform portfolio analysis, monitor risk as portfolio holdings change over time, conduct due diligence for new investments, and importantly, to inform reporting. Here's an example of an output of our analysis. Here we're showing both the supply chain and market risk along the x-axis and operations risk on the y-axis. Companies with capital-intensive facilities like power utilities or resource-intensive companies with complex supply chains like chemicals companies are shown to have high exposure to climate hazards. Those that are more service-based and have a smaller physical footprint are shown to have lower levels of exposure to climate hazards as shown in the lower left quadrant. As an affiliate of Moody's, our data is now available within Moody's Credit View. In addition to the usual credit information available there, financial market actors can now also see climate data from 427 and ESG information from other Moody's affiliates like Vigeo Eiris, which provides ESG ratings. As I mentioned earlier, 427's experience is working with the physical climate models and drawing out decision useful and actionable metrics. Thanks to our partnerships throughout Moody's, we're taking our metrics to the next step and quantifying the financial impacts in dollar terms. Through tools available through Moody's Analytics, like their probability of default tool known as EDF, we have climate adjusted metrics, so investors can analyze additional risk and financial impact from climate hazards, like sea level rise, heat stress, and the others we've already discussed. Finally, the last thing I wanted to note about climate risk and financial impacts is that Moody's Investor Service has started to incorporate our data into their research, reports, and soon to be their credit ratings. They have issued a number of reports using physical climate risk data from 427, including reports on heat stress in US municipalities. They took our data on heat stress and married it with their data on where debt is outstanding, and the Midwest arose as being particularly exposed from a debt and heat stress perspective. In a report on water stress in investor-owned utilities, they found 11 major US utilities representing over $31 billion in rate base have extreme risk to water stress, which has already caused some utilities to retire capital-intensive generation facilities early. This happened to the Tolk plant, which is a coal-fired power plant providing power to Texas and Mexico. And here shown on the screen, they're also using the data to analyze at the facility level. They can look at specific addresses or locations and using their understanding of the importance of particular assets to cash flows, get a better sense of the potential financial impact born from climate hazards. They've used address level data most recently in a report published in September on climate exposure in real estate investment trusts, as well as this credit opinion here on the screen on commercial mortgage-backed securities. If you're curious about other use cases of our data and our research and our partnership with Moody's, I'd encourage you to visit the Insights page on our website and feel free to reach out to me directly. And thank you again, and I look forward to the Q&A.
Thank you so much, Lindsay. I just want to encourage everyone to use the Q&A function. If as the panelists are presenting and something comes to mind, just throw it in there. I've written like 100 questions already, so feel free to throw them in. Okay, finally, our last panelist of this session is Brigham McNaughton, and he is the Director of Sustainability Services at PwC, and he focuses on sustainability strategy, impact assessments, and reporting. He serves clients in a range of industries, advising on core sustainability strategy development based on quantitative analysis and stakeholder engagement, using accepted frameworks such as the Global Reporting Initiative, GRI, and he also coordinates PwC's engagement with SASB, the Sustainability Accounting Standards Board. Thank you so much, Brigham, and welcome. I look forward to hearing your remarks.
Thank you. I really appreciate it and appreciate the opportunity to connect today and share a little bit, particularly on transition risk. So I have the good fortune to work with 800 plus colleagues around the globe at PwC, helping clients on their ESG journey, and particularly thinking about climate change. Within climate, we've been fortunate to help clients on this journey for a while. So we're members of TCFD, the Task Force for Climate-Related Financial Disclosures, which is the leading standard that's brought forth on how companies should disclose on climate risk. We're helping UNFFI work with a group of 22 global insurers to think about transition risk in their underwriting process. And also work with just a range of large companies as they're trying to assess their own climate risk, to try to enhance the resilience of their companies, and to create investor disclosures, which is a relatively new concept in this space. Some of the other panelists have done an awesome job articulating the landscape of climate change and deep diving particularly into physical risk. We wanted to take a few minutes to unpack transition risk. So what you see on this slide here, this is TCFD's framework for thinking about climate risk. There's two big categories, transition and physical risks. On the transition side, we're really talking about the financial impacts of society transitioning to a low carbon economy. Within that, TCFD thinks about four main categories. So first, you've got policy and legal risks. So think about a major carbon attack coming into force, or even litigation similar to what we've seen with tobacco or asbestos or opioids. What that liability might look like, for example, for historic emissions or for failures to provide sufficient disclosures to investors. On the technology side, just think about electric vehicle adoption rates and how that impacts all kinds of sectors and markets, from auto parts to manufacturers, even to gas stations and distribution channels. On the market side, this week we saw announcements, for example, around the adoption of EV rates, just to continue that example, and how prices have really surged for battery components and minerals as adoption has spiked. So thinking through how the trends will lay out as we shift towards a low carbon economy, as different technologies come into play, what that does for commodity prices, for example. Lastly, on the reputational side, that can be acute and hard to translate into a financial risk, but we're already hearing from clients in heavy footprint industries that they're having trouble attracting talent, particularly because of climate, and that's a real challenge for them as they navigate internally. So let me bring that up a level a little bit. So we produce every year a low carbon economy index. So we're tracking how quickly the G20 countries are decarbonizing their economies. And you can see here that decarbonization rate relative to what we need for a 2 degree or a 1.5 degree warming scenario. So as you can see, we're averaging for the last basically 20 years, a 1.6 reduction rate annually, and that's with the tremendous adoption of natural gas coming on board, the surge in renewables that we've seen. If you want to get to a 2 degree or 1.5 degree outcome, we're going to have to accelerate that somewhere in the order of magnitude of 5 to 7 times. So a really dramatic shift in trajectory. So when you think about that, the fundamental ask that our clients are getting from institutional investors is, so what happens to your business if governments and markets act to get that level of dramatic acceleration? What breaks basically in your business model at that point? And I think a year ago, that was a general question of, tell me what happens to your business in a 2 degree scenario. Now we're hearing, much more concretely, Joe Biden's put out a plan to get to zero emission electricity. What does that do to your business model if that goes through? Electricity prices, asset values, et cetera, commodity prices. Similarly, if you look at California's recent ban on internal combustion engines, and there's countries globally that have taken that stance ahead of them, what does that do to your business model? Those are the types of questions that we're seeing large institutional investors putting to companies and asking them to really have the right governance and the right risk assessment processes internally. There's even, just with the new set of disclosures, there's new legal risks just in disclosing more. This summer, we saw a whole spate of litigation around diversity and inclusion reporting and claims and statements, and to the extent there was a gap between aspirational statements that companies were making and the underlying performance data. You can easily see that as a template for climate claims as we go forward with a similar fact pattern. And back in 2010, when the SEC released interpretive guidance for climate risk, we saw some of that activity kick up. I'm not going to cover too much. This is just kind of a map of different regulatory initiatives. I think a lot of these have been touched on already. But I think the fundamental thing that I would add here is that in the US, we're seeing a market-driven conversation where you have investors pushing for enhanced disclosures, but that is quickly translating into a regulatory conversation, whether that's at a patchwork of state requirements like the New York DFS announcement that was already touched on, or the NAIC. But globally, that's really already pretty well underway with EU Commission plans on sustainable finance with an explicit goal to reorient capital flows towards sustainable investments. The point earlier on systemic risk was made, but part of this landscape is thinking about individual companies, but also thinking about the financial system as a whole. And I'll tell you, in our conversations with clients, so for example, with insurance companies writing commercial liability, or with banks writing commercial loans, it's really common to hear, well, we write a 1-year policy, and at the end of that year, we can reprice that, or we can decline to renew. So our individual risk exposure is not that high because we can walk out and exit. The challenge is if you play that out and everyone decides to exit, a certain geography at the same time, or a certain industry or sector of the economy, then you start to get into some real structural challenges. And I think it'll be hard for people to see that in the individual company disclosures and reporting that is coming out. That's something that people are really going to have to read between the lines of what companies are saying and understand the assumptions that they're put in for their risk management tools that they have, and then think about how that plays out at an economy scale. As you just saw with 427, the data sources that investors have are evolving really fast in the capital markets, and they've got increasingly sophisticated models to think about climate risk, both physical and transition. So we have our own climate excellence tool that builds out comprehensive scenarios of policies with industry-specific risk pathways, and we already have kind of preloaded tens of thousands of securities, so we can look at portfolios or down at individual companies. That I think our clients that are operating companies are caught a little bit by surprise of the intensity and the maturity that investors can really look at these risks today. The chart in front of you lays out, there's an ESG ratings firm, MSCI, that evaluates companies. Just a flag for you to make this somewhat more concrete. I took basically every industry where climate change makes up more than 20% of their overall ESG rating. So where it's a primary concern in their ratings. And the text is small here, but you start to see industries like airlines, air freight, oil and gas, but you also see some interesting ones like packaging, construction materials, and certainly insurance. Just to put, the airline point in context here, we did a 2-degree carbon tax scenario for an airline, and they were showing pre-COVID net income that a Paris Accord level carbon tax is something like 3 to 4 times their entire net income, just to give you the scale of the challenge from emissions. Clearly they would adjust and adapt as they move forward, but that's just sort of if you had a sudden imposition of a price, the scale of the impact. So just to close out, I thought it would be helpful to share some practical advice on how to think about assessing and managing transition risk. We just put 6 points on here. The first that we're seeing over and over again is that there's an instinct to say, oh, I know what my greenhouse gas emissions are, and I'm going to reduce my greenhouse gas emissions, and so that's how I'm going to deal with climate risk. We're finding over and over again that greenhouse gas emissions do not equate to climate risk. So for example, just take a gas pipeline. You'll certainly have some greenhouse gas emissions that come fugitive from leaks in a pipeline, but the real risk is if you get a scenario that comes into place where there's a dramatic decline in demand for oil that then strands the whole value of the asset. That's not a conversation about the emissions, it's a conversation about the economics of the business model. And that's, I think, one of our biggest challenges that we see clients having to adjust their mindset is that they have goals in place to reduce their emissions, but that may not be equivalent to what their actual climate risk profile is. The second one is, as I laid out before, the TCFD categories. Climate risk is really quite broad. And one of the things we encourage our clients to think about before they get into any analysis or modeling is to really lay out that conceptual framework at a holistic level and really draw the impact pathways from all the different dimensions of climate to their business, to the P&L, to the balance sheet, and then think through, okay, where are the 4 or 5 areas on this map that have the potential to be quite significant before they go into that deep dive analysis. Number 3 is really think about a range of possible futures. This is scenario analysis that's really called for in the standards. It's not, one point in time. It's really to look for a spread of possible futures. And what we find is the risk profile changes pretty dramatically if you're talking about an orderly transition versus if you're talking about a sudden transition in policies that come into place. So we encourage clients to think about a range of possible futures when they're doing their analysis, and to the extent possible, use third-party standards or there's scenarios so that we can get some comparability in the industry and to take some judgment out, because there's a real risk of cherry picking in that. The 5th here is really thinking about forward-looking. This is quite hard. How will your business change? So for example, if you're a telecommunications company and you're about ready to transition to an entire new generation of network, that's going to fundamentally change your energy usage. That's going to fundamentally change your risk profile. So don't just think about your business today. Think about what your go-forward plans over, a 10, 20-year horizon. That's really hard for our clients, but that's a really important part of how you think this through. And the last point, which seems self-evident, but it's relatively tricky, is before you start on any modeling exercise, think really hard about what you actually want to measure on the back end. What's the measure of the risk? It's easy to just get into a process where you're analyzing data, but if you pick a metric at the front, something like carbon exposed margin, and then work backwards, it can really help guide your effort and analysis. So those were just the tips that I wanted to share, but in the interest of time, we can transition over into questions.
Thank you so much, Brigham. Thank you to everyone who has spoken so far. I am really excited to hear your answers to some of these questions. So I have some questions of my own that I'm going to kick off with, and then I'm going to pull from the increasingly lengthy Q&A. So, okay, this is a question for Lindsay. Brigham, maybe if you could stop sharing, because then we can trade off if there's
I'm trying to figure out how to do that, actually.
Oh, wait,
okay, great. Someone else solved it for me.
at some point we need to show the CLE code. Well, I'll just start digging in and then someone will share the screen. Okay, so Lindsay, this is a question for you, which is challenges around collecting asset level data. You know, so in order to aggregate at the corporate level what someone's exposure to physical climate risk is, you actually need to know like where all their stuff is, like maybe where all their supply chains are, but where all their factories are. I worked on a project in which we were assessing climate related water risk in the mining industry. So we needed to figure out like where they got the water from, how much of it they used. And that data was like not so easy to come by actually, even if you had this global mining company's largest investor actually demanding this data. Like I would say there were two problems. There was like a coordination problem with like some subsidiary in Chile, like not communicating up to like the executive who was maybe actually trying to cooperate with the largest investor about getting the actual like Excel files of the water use. And one problem is corporate, you know, protection. No one wants to share the details of how their competitive industry works publicly. And so I'm wondering how you address both of those issues within your job.
Definitely. Yeah, so our database of around 1 million corporate sites, it's associated with 2,200, 2,300 publicly traded companies. And so some of that data is available through another Moody's affiliate called Bureau Van Dijk. And so we're leveraging their data as part of that corporate facility database. So some of that information, and that's really Bureau Van Dijk's area of expertise, but some of that information is available in some public filings and things like that. And they have very complex trees of ownership of these companies and subsidiaries and things. So that's really their area of expertise, and we're leveraging that address and location specific information in order to provide that view on the facility risk. The supply chain and market risk is really interesting because we're looking at countries where they're selling their goods and the risk to those particular areas, as well as within their supply chains using global trade data flows. So what sector they're in and where those are sourced, where their inputs are sourced.
Great, thank you. Brigham, I was wondering if you could speak a little bit, just describe the different levels of assurances that go to maybe more traditional financial reporting, and then the levels that come into your ESG reporting, like what exactly gets verified and certified by the auditors. And if we were to move into a regulatory landscape where companies were expected to receive assurance, more aggressive assurance, like for their ESG reporting, you know, is your industry ready to meet that demand, and like what would that look like and what would the challenges be?
Yeah, thank you. So fundamentally, when you think about financial reporting, we provide reasonable assurance. When we think about ESG data, so number one, it's voluntary, particularly in the US. This is where companies are just looking for additional comfort or support, or want to demonstrate or signal to capital markets that there's a better degree of reliance or trust they can place. We provide typically today limited assurance, which is basically that nothing came to our attention as a result of doing procedures, which is slightly different from reasonable assurance, where we're attesting that a material error doesn't exist. The practical matter is that even if you get mandatory disclosure, that doesn't necessarily mean you get mandatory assurance. So when you think about the full 10K, for example, or securities filings, there's plenty in that document that is not subject to a financial audit opinion. So, for example, the SEC just put out a new amendment to SK for human capital disclosures. That will go in an area of the 10K that is separate and distinct from the face of financial statements that is subject to our audit opinion. We certainly have an obligation to review those disclosures to make sure they're not inconsistent. But I think there is some discussion in the U.S. around, and certainly at the SEC's Investor Advisory Committee, around whether there should be mandated disclosures. It just, I think, people should understand that that is different from mandating assurance over those. And we really see this as a market-led effort, as clients are seeing that they have hundreds of millions or billions of dollars now at stake around ESG disclosures. They're voluntarily coming to us looking for comfort to help reassure themselves and reassure investors around the quality of that data.
Madison, is it okay if I jump in on this question?
Yes, please. Yeah.
Yeah, it's a really interesting point, and I really appreciate sort of Brigham making that distinction between the, I think clarifying the misperception that if it's in the financial filings, it is automatically externally assured. I think that's a really important point, and thank you for making that. Let me maybe provide some context from the investor perspective and also what we're seeing in the market. I think from the investor perspective, there is still a sense that voluntary ESG disclosures, voluntary climate change disclosures is not reliable. And I think the sense is, if the idea that is that this is reporting on a financial risk, the sense that we get from the investor partners we work with is that they want it to be provided with the same level of rigor that other financial risks are being assessed. And I just pulled up some analysis we've done on this. So a couple of years ago, we released a report called Disclose What Matters. It was an assessment of the 500 largest public companies in the world, their ESG disclosures, and we looked at it using a range of criteria, including assurance. This is data that's a couple of years old, but these are 500 of the world's largest public companies. So you would assume that these are companies that are somewhat sophisticated in terms of their sustainability disclosures and their ESG practices. But of the 500 that we looked at, just 9% provided reasonable assurance of their ESG disclosures. So there is a lot of disclosure out there, but it's really not being verified in a way that is robust. I think a part of the problem as you are thinking about assurance is also assurance practice, right? Especially as we come to climate change disclosures, right? So there's one thing that I think Brigham is right. The market is calling for ESG disclosures, but there's not a whole amount of clarity on how to apply it. So a part of what our report does is we also call on the Public Company Accounting Oversight Board, the PCAOB, to act on this issue, where we call on them to actually issue guidance to public company auditors on how climate change could be appropriately and consistently addressed as a part of the audit and assurance process.
Thank you all. So I'm going to take a question from the Q&A, which is directed to Brigham, but I think actually you all would have an interesting, if you want to weigh in, I encourage you to do so. The question is, if ratings are so sophisticated and granular and decision useful information for investors is already available, why do we need regulatory mandates for public company disclosure? Even if it's as simple as mandating TCFD-based disclosure, what does that really add from an investor perspective? I'm going to tap on my addition, and then you can add to this, because one question is, what do you say to believers in efficient markets about what's happening with risk? Yeah.
So I'm happy to start there, but welcome others. So number one, if you look through my slides and rewatch the replay, I'm not calling for some sort of a mandatory ESG disclosure or climate disclosure regime. I was just pointing out the trends that are occurring globally, and we're starting to see in the U.S. But I know, Veena, you have a different view on that, so happy to bring you in. I think the practical matter is that investors are starting to have resolution at kind of economy scale, or they're outside in, able to look through data sets like Lindsay referenced, but they really want to see, just like any other strategic issue, through the eyes of management, how they're managing the business, how they're thinking about the risks, what risk mitigation efforts that they have and tools that they can play. That's not something that you can get, externally from industry average data sets or a point in time location. That's something you really need management to speak to. And that's why they're really calling on clients. I think if you look at the adoption rates in the US around disclosure, clearly we're in the early days of getting this harmonized and standardized in market norms, but just the adoption rates around TCFD and climate risk would indicate that market forces are at play without a regulatory mandate, and that there's, investors are increasingly clear on their expectations for management teams. But Veena or Lindsay, I know you have other points of view. Please feel free.
Yeah, sure, and I'm happy to weigh in. So Brigham is right in that Ceres has a different perspective. So sort of to the question specifically, yes, I think the rating community is becoming better at integrating climate change into their models. So, and that's great, you know, but if there were better data, clearly with their analysis and their assessment would become more sophisticated, we believe. Also, credit ratings aren't the only criteria that investors keep in mind in making investment decisions. They do analysis of their own. Brigham, Lindsay, and I, and Madison as well, all of us talked about the relevance of the TCFD framework as a part of this conversation. It's worth keeping in mind that the TCFD framework was a framework that was created by the financial community for the financial community. It was created headed up by Mark Carney, the governor of the Bank of England, right? Mayor Bloomberg. The task force included, you know, JP Morgan, BlackRock, Vanguard, you know, State Street, like mainstream financial actors, sort of realizing that in order to address the impact of climate change in their portfolios, they needed decision useful information, which the market was not yet providing. And if you take a look at the TCFD's own annual performance reports, where they sort of track the extent to which TCFD disclosures are being provided in the marketplace, they themselves sort of acknowledge that we are in very early days in terms of this issue. Again, we are of the opinion that if this is about making smart decisions about pricing, smart decisions are made with good information. And the better information that is out there, the better information that is reliable, comparable, and available at scale, it just allows markets to act with much more efficiency.
Yeah, I'll just quickly weigh in as well. I agree with everything that both of you just mentioned. We have information on exposure, but obviously these issues are much more complex than that. Like Brigham mentioned, how are the companies managing for this? And what is their governance around these issues? Are they adapting? Are they engaging with investors on these issues? And so more information, the better. And it is still early days. And so it's important to get more and more information from these companies directly as well.
Thank you. I wanted to ask, so we have a question from the Q&A, which is what additional guidance is needed from the SEC to make climate-related disclosure useful to investors, or is the real issue a lack of enforcement? And I want to add, if you could speak to that question, and then in particular, speak to the pros and cons of having like a government-provided scenario analysis framework. So for those of you paying attention, or who aren't necessarily like familiar with this world, one way to deal with the massive uncertainty of the future in reporting future risks is to report your risks against different possible scenarios of what could happen in the economy, like how much does the world get its act together and start to regulate emissions or not, and then see how your company would like fare in each of these instances. And as Brigham mentioned, if companies are allowed to craft their own scenario about what the future might look like, it might be sort of an Exxon being like, everything will be fine. And so one of the ways to ensure against that would be to have a mandatory scenario analysis disclosure. How much of that is that a realistic goal, or what would the challenges of that be?
Sure, I mean, I'm happy to take that, and I'm sure Brigham and Lindsay have stuff to add. So, you know, do we need rules? Do we need more enforcement? We need both. So in 2010, the SEC did issue an interpretive guidance on climate risk. Brigham mentioned that as part of his slides. We definitely saw an uptick in climate change disclosures in financial filings as a result of that guidance. But on the other hand, if you sort of take a look at the amount of sort of comment letters, enforcement actions that the SEC has taken to actually enforce the 2010 guidance, over the past 5 years, you can count them in the fingers of one hand, right? So the focus and the enforcement, we believe, has been lacking. If you take a look, we've done some analysis. I believe Brookings has either just or will shortly be coming out with some analysis on climate change disclosures in financial filings, which makes this case as well. There is, you know, large companies are starting to talk about climate change, but the focus, a lot of the disclosure is boilerplate. There's a lot of discussion on, there's more discussion on transition risk, less discussion on physical risks. So again, we're not getting that kind of holistic approach on the range of exposures that a company could face from climate change and what that means in terms of their strategy. So Ceres' position is that we need rules to supplement the guidance, right? To remove that ambiguity as to, you know, should I disclose, should I not disclose, and here's how you should disclose is what we believe the SEC should say. And we call on the SEC to calibrate what they're asking for with the TCFD, which I think, you know, I'm a governance person, so everything for me is a governance nail. But I love the TCFD framework because I think it is a governance framework sort of masquerading as a disclosure framework. Because the logic of the TCFD is integrate climate change into risk assessment, do the scenario analysis, right? Figure out how your company fares in a range of scenarios, right? Take that analysis and figure out what it means to your strategy, discuss it with your board, and then sort of figure out what you want to do in terms of setting goals or disclosing your emissions or whatever that last sort of component is. And it's just sort of disclosure every step of the way. So we believe that calibration back to the TCFD and scenario analysis is a really critical component of getting the kind of decision useful disclosure that we need, certainly from an investor perspective, and I believe from a regulator perspective as well.
Does anyone else want to weigh in on that, on scenario analysis, or whether or not a mandatory scenario analysis would be useful or unhelpful?
I have a couple things to say from 427's perspective, that this just highlights the complexity of doing scenario analysis for physical and transition risk. They're very different. So physical risk, carbon has latency in the atmosphere, it persists for hundreds of years. And so policy changes that we make today aren't going to have impacts on, you know, the impacts to hurricanes and sea level rise and all these things, the positive impacts that we want to see until those, you know, policy changes have been around for 10, 20 years. So it's different for transition risk, where policy changes could happen very quickly and have impacts very quickly. So scenario analysis from the NGFS, the Network for Greening the Financial System, they've released a scenario that companies can leverage and portfolio managers can leverage. And the Bank of England has also released some as well. And so I think there's some use, given the complexity of this issue, to start with scenarios that maybe have already been released, but there's also incredible use and importance to doing looking at other scenarios as well, particularly for transition risk, I think.
Great, thank you. Lindsay, I have another question for you, which is, this is from the Q&A. Could you expand a bit on how extreme heat risk is assessed at the local level and how the Midwestern governments identified by Moody's are addressing the risks they found?
Yeah, that particular report that I referenced was leveraging our US Muni data, so data that we have on heat stress and water stress, et cetera, within US municipalities. So those are scores within administrative boundaries in US cities and counties. And so they took that data, and the models we use are global circulation models that are downscaled to those regions in the US. And so they took that data and then married it with their information on debt outstanding. And what Moody's Investor Service does when they're looking at US Muni issuers is they're looking at, do they have adaptation plans in place to deal with the particular hazards that they're facing? And then over time, they monitor whether those US municipalities are implementing those plans, how they're progressing in those plans. And so it's an active dialogue with those issuers.
And just for a company level, just to double down on what Lindsay said, when we've done similar physical risk analysis with clients and we're looking at the resilience of operations, it becomes really immediately clear that you've got a symbiotic relationship with your local infrastructure. And it's really important to engage, locally in communities where you have critical operational assets with the overall resilience planning of the community, and then that's closely tied together. We also see that there's a heavy focus on, the building, the equipment, the footprint, but less of a focus on your employees and their home situation and their own resilience. And as you've seen through COVID, everybody's business continuity plan is everybody works from home. That doesn't work particularly well if you don't have a home given in a severe weather event. So I would just layer that angle into it as well.
Thank you all. I'm going to take another question from the Q&A, which is, does the panel view convergence of the alphabet soup of reporting and analysis standards as a desirable or undesirable outcome? If so, what elements are viewed as essential to assure comparable information from reporting companies? So I guess first the question is, do you think there's a convergence? And then secondly, do you think it's a good one?
So, well, I'm happy to, and I assume at this point we're talking ESG broadly versus climate, because I actually do think in climate we have a fair amount of convergence around TCFD. There may be a survey like Carbon Disclosure Project where you're filling out, but that's harmonized against the TCFD. So I think in climate we're pretty close to there. There's a lot of specificity on how that works out underneath. I think it's really important to separate out reporting frameworks from ratings, rankings, et cetera. I do think it is helpful for there to be norms for companies to understand what they should be disclosing. But I think the reality is you have a capital market where trillions of dollars are now competing on ESG assets. They're competing based on their acumen for how they think about and understand these risks and performance. So fundamentally, you're going to get different investment research angles, different taxonomies for thinking through that. I think that's healthy, and that's really important for asset managers to be continuously understanding that. That's different from what information is provided or delivered as sort of a minimum common bar. And on that, I would just say that it fundamentally comes down to what's the problem you're trying to solve. If your problem you're trying to solve is investor disclosures on ESG, I think there's pretty clear alignment now coming to that's what SASB is built for. If your primary objective is to provide transparency to a wide range of stakeholders and to manage a beyond investor audience, it's pretty clear that GRI is a tool that is built for that. And there's some efforts, now to try to bridge across that, but I would just say, be really clear on the problem you're trying to solve, and then the reporting framework becomes somewhat obvious that you should use for that problem.
Yeah, I mean, I really strongly agree with that. I will say that the disclosure standards are trying, I mean, they hear the cry from the market around the confusion. So there have been a few efforts to try to figure out how they play well with each other and how the various pieces of the jigsaw puzzle sort of fit together. So a couple of years ago, they announced an initiative called the Corporate Reporting Dialogue that did some mapping that was helpful. And there's clearly a sense, I believe there was a statement of intention to work together, which the GRI, SASB, and other reporting standards put out, I believe, somewhat recently, maybe even this past month. I don't think that there is going to be that one ring that rules them all, right? Because as Brigham said, these various standards were created to solve various problems. So I agree with Brigham that, they will continue to exist in some way or form, and they should exist. I think the problem that they are working on solving is that when there is sort of disclosure on the same issue, like climate change, to make sure that everyone is asking for the same indicators, so there is no expectation on companies to report on the same issue, just using multiple perspectives and using multiple formulae. I think they are, in fact, working on that. That is, in fact, a work product that they are looking to put out. But I mean, again, from our perspective, more disclosure, lenses on disclosure are great. SASB and GRI have also put out an approach on how their approaches to materiality sort of fit together. SASB, as Brigham mentioned, very focused on financial materiality and sort of the investment approach. But there's also sort of a neat little approach based on a document that they put together talking about how GRI sort of may also focus on issues that companies could consider to be pre-material. So may not be material right now, but could eventually sort of, where the materiality impacts may sort of manifest in the medium and long term, sort of bringing into play sort of the time dimension associated with when these impacts start to manifest, which I find very interesting.
Thank you all so much. We unfortunately have to wrap up. That's the end of our panel. Thank you, Brigham, Veena, and Lindsay. I've just learned a lot, and I hope that all of our attendees have learned as much as me. Okay, here is our CLE code. The CLE code for this morning's session is climate, so please write it down for the end of the day when you have to submit it. And for that, I'll close. Thank you all so much. And next up is our lunch discussion between three great economists, and I really look forward to hearing from what they have to say.